certainly a lot of challenges out there at the moment. With challenges come opportunities, right?
That's right. Yes, yeah, you're right. I think, you know, the interesting thing is you think back a year ago, we spoke about the potential of a double-dip recession. And then suddenly we started talking about emerging markets versus developed markets. And it turned to the whole European debt crisis. And beginning of this year, the Middle East and the tension there, and then soon Japan. So I think it's very clear that the market, unfortunately, can only think about one thing at a time. So the others are still there. But every time there's something new happening, and probably in a month when we sit here again, you know, there will be another challenge that we talk about. So the important thing is to actually look through all of these things that we read about and determine what of those are fundamentally going to impact the world going forward 3 to 5 years, and which is purely just sentiment and emotions. So I think, yes, if you look fundamentally at the major challenges, it's still what the Western governments are facing. So it's probably the housing market in the US, the debt issue in Europe, similar in the UK, and you know, Japan been facing quite a weak economic environment for many years, and what's been happening in terms of the earthquake is obviously not helping. But I don't think that's a fundamental long-term thing that will impact Japan and the growth potential. So I think what's important is to first of all look at what these governments are putting in place trying to solve these problems. And despite some of the negative concerns that we still see coming out, I do think that they're making reasonable progress. And in 3 or 5 years, they'll probably be in a much better position. So if we can put that aside and say, well, they're addressing the big fear at the moment, and it won't be the end of the world. And then you start looking at the investment opportunities, obviously the market being quite emotional and driven by humans. They only look at the fear side of it, and that's reflected in prices. So we still believe that there's great opportunities in developed market equities, especially in countries like Europe, where the concern is probably much bigger than the underlying value that you see in those companies. And having said that, those companies are actually in a very healthy state, with a lot of cash on their balance sheets, paying handsome dividends. Most of those are running around in emerging markets looking for opportunities to invest. So we still believe that you'll make a reasonable return investing longer term in developed market equities, especially in Japan as well. Japan, for example, if you look at price to book value on the market in general, they're trading at historic low points. And yes, there's some changes taking place in terms of their thinking from the company management side in terms of contributing to return on equity and making it a better business environment. But if you take, for example, currently insurance companies, obviously they hammered after the earthquake. But if you look at those companies, most of them are actually not reliable for covering earthquakes and tsunamis, because they know that that's something that's regular in Japan, so they don't cover that. So in the end, the bill will largely go to government. But yet, if you look at how their share price has been tumbling, for contrarian value investors, that's a buying opportunity, because those companies are not only operating in Japan, but there's a great network into other insurance companies globally as well.
Let's take a look at some of those opportunities in just a moment. First of all, you said you have to look 3 to 5 years ahead, see how the world's sitting then. If you look at the US versus Europe and the UK for that matter, and we saw that budget coming out of the UK last week, tough austerity measures in Europe and the UK. We don't have the same approach in the United States. Who do you think is going to come out of this better in 3 to 5 years' time?
I think it's almost like an ugly competition. Very different issues, I believe, in those regions. I've mentioned earlier in the US is probably the housing market. They do have outstanding debt, also quite a large amount relative to their GDP. Their benefit is that they still sit with the reserve currency in the world. They can print money if needed. They can, and there's still a huge demand for US treasuries. But, and I think someone earlier this morning mentioned it as well, we do need the US consumer to feel healthier, and that's all built on the housing market. So there's still softness in the housing market, but we believe it's very close to the bottom. And going forward, that will just contribute to the US consumer starting to feel healthier. I think the recovery in the equity market already contributed quite a bit. So I think in the US it's looking or focusing on the housing market and the health of the US consumer. The UK, and maybe just on the US, obviously a lot of that's already priced into the dollar, so the dollar is weaker, and in a way that's supporting the US exports to the rest of the world. So they're also benefiting at the moment in terms of stronger exports, high-tech stuff, but that's also beneficial for that economy. The UK is, in a way, they're benefiting from the fact that they've got their own currency, and the currency is doing a lot of the hard work for them. And I think between the three, they're probably in a position where they will get it right. It's tough. We've seen the strikes and the riots in London at the moment. But if you look at the budget last year, they do expect that by 2015 they will be back to a surplus, which is very positive. But it won't be easy. And if you look at the news coming out at the moment, they're giving over the budgets to the local authorities. And it's tough decisions that they need to make. It's things about, do you keep the swimming pool open for the public? And all of that's contributing to that emotion and riots.
Well, I was chatting to your colleague David Moore on Friday, saying that South African equities still not trading at a big enough discount to developed market equities to make them attractive. How, as a South African investor or portfolio manager, would you be positioning yourself between South African equities and bonds and offshore bonds, offshore equities rather than bonds?
Yeah, if we view South Africa as part of the bigger emerging market group, obviously we all benefit from global demand, global growth, and especially the resources play as well. Over the weekend, the IMF actually warned that they do believe that Latin America is overheating, Brazil and Chile especially, and that's something that they need to address going forward. So if you look at all of that, compared to a year ago, we're probably in a better position because we did see quite a big sell-off in emerging markets, especially emerging market bonds off late for the beginning of this year. Huge capital outflow in terms of our own government bonds as well. So in our mind, we're probably closer now to fair value, but we're not cheap. But we're also not expensive. So the way we look at it is to say that there's definitely some money to be made over 3 to 5 years in markets like South Africa or other emerging markets, because we will benefit from global growth continuing and the whole emerging market play. But we do believe that there's probably a slightly better opportunity to make a little bit more money in some of those developed market opportunities, where you buy similar companies but just at a bigger discount. So from a valuation point of view, and not just pure economic point of view, if you can buy some of those developed market companies at a bigger discount, but they do benefit from trading in the high economic growth environments like emerging markets, that's probably a better positioning to be. So at the moment we overweight slightly developed markets over emerging markets, which includes something like South Africa.